Folks, it is indeed a good morning after the exhilarating World Cup finale match, making sure the edge of the seats were never left with oh so many twists. I mean, really glad to have been warmed up quite well by the financial markets in the last few weeks through its volatility to take on this match charged up. Folks, welcome back to Almus Market Mornings with Shikhar Garg, and we'll move into the financial updates right away. But with the close of World Cup yesterday, we also saw one of the very active weeks for financial markets come to an end. So, JK, what's up ahead? Are we going to see the markets in some slumber, or there's still some volatility that we need to embrace?
Good morning. I think as we're heading to Christmas period, markets are actually divided down the middle on what to expect in the coming year. So we will be possibly pausing in the moves and trying to guess or outguess each other and see what trend can emerge in the new year. Definitely, there is clear-cut demarcation in the thinking between market and the central banks. Markets think that the central banks may be overdoing on the hikes, and that can lead to a big damage on the economy that is already looking fragile. Friday's data once again confirmed on the US economy. At the same time, central bank themselves are keen not to underdo things in their fight against inflation and repeat the same policy error that occurred in 1980s when, due to early cutting of rates, inflation rose again its ugly head, and they had to go back to very severe tightening. So that is the thing that Powell is aiming at, and even the other central banks are very keen not to follow that path. With, of course, the Fed meeting over, the members are back out of the blackout period, and we had both John Williams, New York Fed president, and also Mary Daly speaking hawkish, saying that rates can go even beyond what the dot plot indicated, and that's what came out on Friday. But again, markets were not listening, particularly on the yields. In US, they were lower, although in Europe it was higher. Two-year yield in US was 4.30 earlier and came down to 4.18, although ended slightly higher. More particularly, the yields are going down in the near term rather than on the long term. Therefore, we have the curve that is slightly flattening out now. But definitely, it indicates market strong belief that Fed would be retracing much earlier than what they have been saying openly. European yields, of course, were responding to the statements from Lagarde on Thursday, which was really very hawkish, and we had big rise in Italian bonds and the German bonds, and the spread between the two widening. And then again, fears that Europe might face another crisis on the bond market. So that's the reason why euro also took slight beating, but not really that down. Still trading about 1% from the top. Stock markets started to consider that bad news is after all bad news, and not bad news is good news. What I mean is, earlier, whenever we used to get a soft data, people used to assume that it will lead the central bank to go for a put or kind of slow pausing on the rates, but that is not to be now. And with the central banks sounding hawkish, markets think that whenever there is a bad news, it means that economy is really getting worse, and therefore stocks were sold off. And while at the same time, money market bets show that the terminal rate will be not more than 4.8 by middle of next year, and maybe 4.4 by the end of 2023. That means they're assuming a cut. So it's a stark difference that you are seeing between central banks and the markets. S&P Global Flash report, of course, showed business activity contracting further. New orders slumped to their lowest level in just 2.5 years, and manufacturing and service sectors fell to 44.6 from 46.4. So already in contraction territory, and further deep into the contraction territory. Important to note that inflationary pressures in the service sector cooled notably in December as input costs rose at its softest pace in since 2020 October. Yen staged a better performance other than other currencies. Even a speculation about Bank of Japan meeting this week writes Bank of Japan will be deciding on its policy Tuesday while no change is expected. Some market participants have begun betting on a tweak to their stimulus as Kuroda is likely to depart in April. In general, currency market also show a divergent behavior typical of the year-end positioning moves. Euro and GBP were hit by profit taking, while USD and yen were stronger on risk aversion, and even gold displayed, some strength despite closing with a big loss for the week. I guess there will be more flow-based random moves in the currencies rather than any uh, big trend that will be followed, and people will still be assessing what to expect next year with so much on the plate. Rupee, there have been some developments last week, like the improved trade deficit, good moderation in CPI below 6%, WPA falling for sixth consecutive month, and FX reserves once again increasing. This for the fifth week in succession, and also forward premiums higher, near 2% for 1 year, possibly luring some export selling. So these could actually see the rupee retrace some of its weakness, seen. But oil price is a question mark as we do see China looking to open up and US probably looking to rebuild the strategic petroleum reserves around these levels. But in general, falling commodity prices globally is a good news for India and will help further moderate the import bill. We look for cues from central bank more than anything as far as the rupees is concerned. I think they will be keen to keep the USD-INR range between 82 and 83. Possibly some more correction in the cross INRs like Euro INR and GBP INR. Thank you. Have a nice day. Thank you.
Okay, wonderful, JK. And yes, folks, now is the time where all the market participants, as JK mentioned, will be in a bid to guess or outguess the market participants. But out of that, they are not going to be, any significant trend-based move. It's going to be more of a flow-driven market because of the illiquidity coming in for the year end. Other than that, as we can see, the yield curves have started flattening. I mean, even though the flattening has been quite less, but since it has been deepening for a while, this news can be leading to the change of sentiments, even though the market participants have continued to expect the terminal rates at 4.8%. Other than that, oil continues to be another thing for concern for the Indian markets as the oil prices have hit nearly 10-12 months low, and we can expect as we are hearing SPR replenishment by the US can still continue to put the pressure on the oil prices, while the trade deficit has been on the higher side for the past whole year. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.